I'm Yaneli, also known as Miss Be Helpful, with another FinCap Friday brought to you by NGPF.
In March of 2025, the US stock market dropped in a major way, and experts warned investors to prepare for a lot of market volatility. But what does that even mean? Imagine that the stock market is like a roller coaster. When things are stable, the ride is smooth and predictable. But when there's a lot of confusion and uncertainty, the ride gets bumpy. Market volatility basically means that stock prices go up and down more dramatically, and these changes start to happen more and more often. Plus, it's much harder to predict what will happen next. Think of it like on a good day, a stock's price might change by $1 or $2, but on a volatile day, that same stock price could swing by $10 to $20. There's a lot of factors that contribute to market volatility, and the first one that affected the stock market in early 2025 was economic indicators. The key economic data points that changed in the first few months of 2025 are how much the economy was expected to grow throughout the year, how much unemployment there might be in the year, and what the inflation rate would be. Now, these things don't directly connect to the stock market, but they do change the opinion of investors who might then change their investment strategies as an emotional reaction. Market sentiment is basically the psychology of the people who are investing in the stock market, and it could definitely change the way the market moves, especially during times of uncertainty, because investors get nervous. If they think companies are going to struggle to make a profit, or if they think that the economy is going to start to slow down, then they start to sell their stocks, which pushes prices lower in the market. Next up, global events. International relations, geopolitical tensions, major world events, these things can create uncertainty in the stock market too. In the US, the threat of tariffs made a lot of investors fear that these tariffs might lead to a recession. Tariffs basically act like extra taxes on goods, making them more expensive. And when companies have to pay more for materials like steel and aluminum, they often pass those extra costs down onto consumers by raising their prices. Finally, there's corporate earnings. Unexpected changes in company performance or earnings expectations can lead to stock prices changing fast. For example, major airlines, including American Airlines, Delta, and Southwest, reported signs of less demand and they changed their earnings forecasts downward. This shows that customer spending might be weaker than a lot of people thought it would be in 2025. So all of these factors collectively contributed to a volatile market environment with the S&P 500, the Dow Jones, and the Nasdaq all experiencing significant declines in March of 2025. But only time will tell whether the 2025 year ends up being a good year or a bad year overall for the US stock market.